Ever wondered how to predict stock market trends and make informed trading decisions? Well, you're in the right place. Welcome to the world of technical analysis. It's a field that might seem complicated at first, but don't worry, we're here to break it down for you. Technical analysis is a method that financial experts use to evaluate investments and identify trading opportunities. It's all about analyzing statistics gathered from trading activity, such as price movement and volume. You see, it's not just about what's happening now, but what's happened in the past. By looking at patterns and trends from yesteryears, one can make educated guesses about what might happen in the future. Imagine technical analysis as a crystal ball, but instead of vague visions, it gives you data-driven insights. It's like a detective piecing together a puzzle, except the puzzle pieces are historical price patterns, trading volumes, and other market data. Now, why should you care about technical analysis? Well, it's a tool that can help you make informed decisions about when to buy and sell stocks. It can help you identify trends and, more importantly, predict changes in those trends. You see, in the world of trading, timing is everything. Knowing when to jump in and when to jump out could be the difference between a profit and a loss. And that's where technical analysis comes in. It's like having a roadmap in an unpredictable journey, giving you clues about when to hit the gas and when to hit the brakes. In this video, we're going to break down the process of technical analysis into easy-to-understand steps. We'll cover everything from the basics to understanding price trends and the role of volume in technical analysis. We'll make sure you walk away with a solid understanding of how to use this tool to your advantage. So, are you ready to dive in? Good, because we're just getting started. Stay tuned as we delve into the intriguing world of technical analysis. So, what's the first step in conducting a technical analysis? Well, let's dive right in. The key to technical analysis lies in historical data. It's like a treasure map, guiding us to potential gold mines in the market. This data reveals patterns and trends that help us forecast future price movements. You see, the financial market is just like history. It often repeats itself. Therefore, historical data becomes our crystal ball, allowing us to predict how prices might behave in the future. But how do we make sense of all this data? That's where charts and graphs come in. They're the language of technical analysis, translating raw data into visual stories. Imagine trying to read a book with no words, just a series of numbers. It would be pretty hard to understand, right? That's what charts and graphs do. They turn numbers into a narrative, making it easier to spot patterns and trends. Now let's talk about the two most crucial elements in technical analysis: price trends and volume. Picture a busy market filled with buyers and sellers. The price trends are like the currents in a river, showing us the direction of the market. Are the prices generally going up, down, or moving sideways? Recognizing these trends is like having a compass in the financial wilderness. Next, we have volume. This is the number of shares or contracts traded in a security or market during a given period. It's like the pulse of the market, reflecting the intensity or lack of interest in a stock. For example, a high volume indicates strong investor interest and a potential for price movement. On the other hand, a low volume might suggest investor indifference or a lack of momentum. Understanding volume gives us a sense of the market's heartbeat, helping us make informed decisions. In the grand scheme of things, technical analysis is a bit like detective work. It involves piecing together clues from historical data, charts, price trends, and volume to predict where the market might go next. With these basics, you're ready to start analyzing. Price trends. What's the big deal about them, you may ask? Well, in the world of trading, understanding price trends is like having a compass in an ocean of numbers. It helps you navigate the tumultuous waves of the stock market. Picture price trends as the general direction in which the price of an asset moves. They are the heartbeat of the market, providing critical insights into the forces of supply and demand. Recognizing these trends can help traders predict future price movements and make informed investment decisions. So let's dive into the three types of price trends: uptrends, downtrends, and sideways trends. First, we have the uptrend. Think about climbing a hill. An uptrend is when prices are generally increasing over time. This trend indicates a strong demand for the asset, with buyers being more aggressive than sellers. It's like a green light signaling investors that the asset is in demand and it might be a good time to jump on the bandwagon. Next, we have the downtrend. Picture walking down a slope. A downtrend is when prices are generally decreasing over time. This trend suggests that sellers are more dominant than buyers. It's like a red light warning investors that the asset might not be in demand and it might be a good time to hold off on buying. Lastly, we have the sideways trend, also known as consolidation. Imagine walking on a flat surface. A sideways trend is when prices are moving within a relatively stable range. This trend indicates that the forces of supply and demand are relatively balanced. It's like a yellow light advising investors to wait and watch for a clearer signal. Remember, price trends are not crystal balls. They can't predict the future with absolute certainty. But they do give you a sense of the market's pulse, allowing you to make more informed decisions. So, why are price trends a big deal? Because they provide valuable context. They offer clues about potential investment opportunities and risks. They help you understand the market's ebb and flow. Mastering price trends gives you a powerful head start in technical analysis. It's like learning to read the market's language, and that's a skill worth mastering. Volume, another key player in our technical analysis journey, but why? Let's delve into this critical component of technical analysis. Volume refers to the number of shares or contracts traded in a security or market during a given period. It's essentially the total activity surrounding a security or market. Now, you might be thinking, that's interesting, but how does volume play into technical analysis? Here's where it gets exciting. Volume is often used to confirm the strength of a price trend. In other words, changes in volume can signal where the price is headed. When volume increases, it's often a sign that a trend is gaining strength. On the other hand, if volume decreases, it could indicate that the trend is losing steam. This concept is summed up in the common saying among traders, volume precedes price. This means that a surge in volume can often predict a price change. If volume spikes and the price is rising, this could indicate a strong upward trend. Conversely, if volume goes up and the price is falling, it could signal a strong downward trend. But here's a caveat. Volume is just one piece of the puzzle. While it can confirm the strength of a trend, it doesn't always guarantee a particular outcome. Market conditions, news events, and other factors can influence stock prices. So, while volume is a crucial tool in your technical analysis toolkit, it's not a crystal ball. It's also important to remember that volume information is readily available. Most trading platforms include volume data, often represented as a bar chart below the price chart. This allows you to easily see how volume is changing over time in relation to price changes. In summary, volume plays a critical role in technical analysis. It can confirm the strength of a price trend and can often provide clues about potential price movements. But remember, it's most effective when used in conjunction with other indicators and tools. Understanding volume can significantly enhance your technical analysis skills. Now that you're familiar with the role of volume in technical analysis, you're one step closer to becoming a more informed and strategic trader. So, we've journeyed through the basics of technical analysis. What are the key takeaways? Well, we began by unraveling the intricate world of technical analysis. We've seen how it's not just about numbers and charts, but a comprehensive approach to understanding the market's heartbeat. It's a way to interpret the past, comprehend the present, and anticipate the future of market prices. We delved into the basics, underlining the importance of historical data. This data doesn't simply represent past events, but is valuable information that helps us understand market trends and patterns. By analyzing this data, we can start to see patterns and trends that repeat over time. It's these repetitions that give us a clue about where the market might be heading next. Next, we focused on the importance of price trends. Remember, the trend is your friend. Whether it's an uptrend, downtrend, or sideways trend, understanding the direction of the market is crucial. By identifying these trends, we can anticipate potential future price movements, helping us make informed trading decisions. We then explored how volume plays a crucial role in technical analysis. Volume, the number of shares or contracts traded in a security or market during a given period, is often overlooked. However, it's a vital ingredient in the analysis recipe. It provides clues about the strength of a price move. High volume points to strong investor interest and a higher likelihood that the price will move in the direction of the trend. So, let's wrap it up. Technical analysis is about understanding the market's language. It's about interpreting historical data, identifying price trends, and considering volume to make informed predictions about future price movements. It's a tool that can help you make better, more informed trading decisions. However, like any tool, it needs practice, patience, and perseverance. Remember, technical analysis is a tool, not a guarantee. But with it, you're well equipped to navigate the financial seas. Happy trading!